Today, the economic chickens coming home to roost. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. Well, the IMF released their latest report, and it's not good reading if you're looking for strong growth. That said, commodity-rich Australia is one of the few countries to receive an economic growth upgrade by the IMF after the global outlook was slashed due to war in Ukraine and soaring inflation. The IMF division chief for Australia, Harold Finger, said Australia would receive a boost from the surge in the price of commodities such as gas, iron ore, coal and wheat. The global oil benchmark, Brent crude, was trading at $113 US a barrel, and iron ore was about $155 US a tonne on Tuesday. The Fund's World Economic Outlook, which was released on Tuesday, said Australia's economy was expected to expand at 4.2% in 2022, up from 4.1% forecast back in January. While that's only a modest upgrade, it bucks the trend of the IMF, smashing global growth by 0.8 percentage points to 3.6% this year because of the war in Ukraine, supply chain disruptions, and surging energy prices. That does affect the majority of countries, Mr. Finger told the AFR. Australia, in that respect, is in a slightly better spot because it is a net commodity exporter. The current higher commodity prices by themselves are actually benefiting Australia. But of course, the lower trading partner growth is a negative for Australia. China, Australia's largest trading partner, was identified as a source of growing risks due to frequent and wider-ranging lockdowns that have slowed manufacturing activity and could cause new bottlenecks in global supply chains, the IMF said. China's growth forecast was downgraded to just 4.4%, almost half the 8.1% pace recorded in 2021, when the world's second-largest economy rebounded from COVID-19. And by the way, in Canberra, the pre-election economic and fiscal outlook, the PFO, is expected to be released by the Treasury and Department of Finance on Wednesday. The IMF tipped local inflation to average 3.9% this year due to surging petrol prices and the low 4% jobless rate, which is tipped to gradually generate better wages growth of around 2.9% in 2022. Mr. Finger said the Reserve Bank of Australia was right to soon be increasing interest rates to dampen inflation, but price pressures were not as evident as in the US, New Zealand and South Korea. There's a risk, of course, that over time inflation expectations might pick up and de-anchor, and so it's important for the RBA to stay ahead and raise interest rates accordingly, he said. The IMF expects the inflation pressure to be somewhat temporary as oil prices eventually ease and as monetary policy and governments' budgets tighten. They actually forecast inflation to fall to 2.7% in 2023, which is inside the RBA's 2% to 3% target range. Part of the commodity spike is going to peter out over the coming year or so, Mr. Finger said. But a part of inflation is also domestic and homegrown, and it will take a little bit longer to bring that down. Despite the near-term income boost from fossil fuels, Mr. Finger says the nation must set a credible medium-term emissions reduction target to achieve the 2050 net zero emissions target and to facilitate the energy transition. Then, of course, you need to look at also compensating those industries and regions most affected by the increasing carbon price. The coalition government is sticking by its 26 to 28% emissions reduction goal by 2030, but expects to beat that and achieve a 35% cut on 2005 levels. The government has refused to introduce an explicit carbon price or tax, instead opting to spend billions of dollars of taxpayers' money and rely on technology advancements to reduce emissions. Labour, on the other hand, has set a 43% emissions cut by 2030 and plans to introduce a form of carbon pricing through a so-called safeguard mechanism that puts a cap on emissions of major emitters and permits trading of pollution permits. Mr. Finger repeated the IMF's call for a sharper focus on productivity-enhancing reforms to lift innovation, increase competition in product markets, and improve infrastructure investments to harness the potential of the digital economy. We do think it's important to work on productivity growth, he said. Like in many other advanced economies, that has been on a declining path over the last years in Australia. Planning and zoning reforms by state and local governments will also help to increase housing affordability by boosting supply of homes. And separately, the Reserve Bank of Australia board meeting minutes released on Tuesday signalled that a June interest rate rise was likely. Internationally, the RBA noted members agreed that the combination of high inflation, declining real wages, rising interest rates and falling consumer sentiment had clouded the near-term outlook for global growth. But more broadly, the IMF said that global financial conditions had tightened notably and downside risks of the economic outlook had increased as a result of the war in Ukraine. The tightening had been particularly pronounced in Eastern Europe and Middle Eastern countries with close ties to Russia, reflecting lower equity valuations and higher funding costs. This has occurred just as most of the world was slowly bringing the pandemic under control and the global economy was recovering from COVID-19. Financial stability risks have risen on several fronts, even though so far no global systemic event affecting financial institutions or markets has materialized, they said. A sudden repricing of risk resulting from an intensification of the war and associated escalation of sanctions may expose and interact with some of the vulnerabilities built up during the pandemic, leading to a sharp decline in asset prices. With the sharp rise in commodity prices anticipated to adding to pre-existing inflation pressure, central banks are faced with a challenging trade-off between fighting record high inflation and safeguarding the post-pandemic recovery at a time of heightened uncertainty about the prospects for the global economy. Bringing inflation back down to target and preventing an unmooring of inflation expectations requires a delicate act in removing accommodation while preventing a disorderly tightening of financial conditions that could interact with financial vulnerabilities and weigh on growth. Incoming inflation data suggests that more decisive tightening of monetary policy is necessary in many countries. After rising early in the year on concerns about the inflation outlook, advanced economy nominal bond yields have increased further since the invasion amid heightened volatility of rates, and inflation break-evens, that's a market-implied proxy for future inflation, have risen significantly on the back of sharper higher commodity prices. Repercussions of the Russian invasion of Ukraine and ensuing sanctions continue to reverberate globally and will test the resilience of the financial system through various potential amplification channels, including direct and indirect exposures of banks and non-banks, market disruptions in commodity markets and increased counterparty risk, poor market liquidity and funding strains, acceleration of cryptonization in emerging markets, and possible cyber-related events. They said the war has already had an impact on financial intermediaries, non-financial firms, and markets directly or indirectly exposed to Russia and Ukraine. Europe bears a higher risk than other regions due to its proximity, reliance on Russia for energy needs, and the non-negligible exposure of some banks and other financial institutions to Russian financial assets and markets. Banks' direct exposure to Russia are relatively small, except for some non-systemic European banks. But banks' indirect exposures are more difficult to identify and assess because they are less well known, especially the extent of interconnectedness, as it is difficult to quantify them in the absence of detailed and consistent disclosures by countries or by specific activity types. The risk is that indirect exposures could be meaningful and surprise investors once revealed, leading to a sharp rise in counterparty risk and risk premia. Foreign non-bank financial intermediaries have sizable investments in Russian assets, with US and European investment funds accounting for most of the exposures. As a share of total assets, however, their exposure to Russia is small. Dedicated emerging market funds have maintained a cautious stance on their exposures to Russian debt since the Crimea occupation in 2014, reducing their share of Russian debt from more than 10% before 2014 to about 4% in 2022. Funds benchmarked to global indices have had a much smaller exposure to Russia, with an average 0.2% of their assets invested in Russian debt in 2022. They went on to say, though, that severe disruptions in commodity markets and supply chains across the globe have caused extreme volatility in commodity prices, amplified by pressures in commodity trade finance and derivative markets. Dealer banks play a crucial role and have significant exposures in these markets, including by providing liquidity and credit to a small group of large energy trading firms that operate globally, are largely unregulated, and are mostly privately owned. Pressures in commodity markets, often magnified by poor liquidity, have led to lower risk appetite and rising counterparty risk concerns, with implications for funding conditions. And emerging and frontier markets are facing tighter financial conditions and higher risk of capital outflows. Since the war in Ukraine began, emerging markets' hard currency yields have increased at a rapid pace, akin to earlier episodes of emerging market stress, before retracing some in mid-March. The number of issuers trading at distressed levels has surged to 25% of issuers, surpassing pandemic peak levels. And the deterioration in spreads, combined with the increase in US yields, has pushed financing costs well above their pre-pandemic levels for many borrowers. Markets remain open for issuance at these high levels of funding costs, though. And flows in local currency bonds and equities have come under pressure, experiencing the largest weekly redemptions since March 2020. Tighter external financing conditions on the back of US monetary policy normalization and heightened geopolitical uncertainty are likely to increase the downside risk for portfolio flows, they said. And in China, the recent equity sell-off, particularly in the tech sector, and the increase in COVID-19 cases has raised concerns about a growth slowdown, with possible spillovers to emerging markets. Ongoing stress in the battered real estate sector has increased financial stability risks and added to growth pressures. Extraordinary financial support measures may be necessary to ease pandemic-driven balance sheet pressures, but would add further to medium-term debt vulnerabilities. The interlinkages between emerging market sovereigns and domestic banks have intensified over the past 2 years, as additional government financing needs to cushion the impact of the pandemic have been mostly met by the banks. As a result, bank holdings of domestic sovereign debt surged to historic highs in 2021. Distress in emerging markets could trigger an adverse feedback loop between sovereigns and banks through multiple channels, the so-called sovereign bank nexus, potentially reducing bank soundness and lending to the economy. And the war in Ukraine has brought to the fore a number of medium-term structural issues that policymakers will need to confront in coming years, including the possibility that the geopolitics of energy security may put climate transition at risk, the risk of fragmentation of capital markets, and possible implications for the role of the US dollar, the risk of fragmentation in payment systems, and the creation of blocks of central bank digital currencies, more widespread use of crypto assets in emerging markets, and more complex and bespoke asset allocations in an effort to preempt the possible imposition of sanctions. The war has made evident the urgency to cut dependency on carbon-intensive energy and to accelerate the transition to renewables. However, in the face of growing concerns about energy security and access to energy sources, the energy transition strategy may face setbacks for some time. The current energy crisis may alter the speed of phasing out fossil fuel subsidies in emerging markets and developing economies, while rising inflation pressures may also lead authorities to resort to subsidies or other forms of fiscal support to households or firms. And crypto asset trading volumes against some emerging market currencies have spiked following the introduction of sanctions against Russia and the use of capital restrictions in Russia and Ukraine. This is occurring against the longer-term increase in such cross-border transactions, bringing to the fore the challenges of applying capital flow measures and sanctions. And while technological innovation in financial activities, or fintech, can support inclusive growth by strengthening competition, financial development and inclusion, the rapid growth of risky business segments can be a cause of concern for financial stability when fintech firms are subject to less stringent regulations. So they made a number of policy recommendations. Firstly, that central banks should act decisively to prevent inflation pressures from becoming entrenched and avoid an unmooring of inflation expectations. To avoid unnecessary volatility in financial markets, it's crucial that central banks in advanced economies provide clear guidance about the normalization process while remaining data dependent, they said. Emerging markets remain vulnerable to a disorderly tightening of global financial conditions, and many central banks have already significantly tightened policy. Further rate increases or policy normalization with respect to other measures taken during the pandemic, such as asset purchases, should continue as warranted according to the country-specific inflation and economic outlook to anchor inflation expectations and preserve policy credibility. Policymakers should tighten selected macroprudential tools to tackle pockets of elevated vulnerabilities while avoiding a disorderly tightening of financial conditions and striking a balance between containing the build-up of vulnerabilities and avoiding pro-cyclicality appears important given uncertainties about the economic outlook, the ongoing monetary policy normalization process, and limits on fiscal space in the aftermath of the pandemic. While taking steps to address energy security concerns, policymakers should intensify their efforts to implement the 2021 United Nations Climate Change Conference, the COP26 roadmap, to achieve net zero targets, and they should take measures to increase the availability and lower the cost of fossil fuel alternatives and renewables while improving energy efficiency. They should scale up private finance in the transition to a greener economy and continue to strengthen the climate finance information architecture. And policymakers, they say, should develop comprehensive global standards for crypto assets along the activity and risk spectrum. A more robust oversight of fintech firms and decentralized finance platforms is needed to take advantage of their benefits while mitigating their risks. To preserve the effectiveness of capital flow management measures in an environment of growing usage of crypto assets, policymakers need to pursue a multifaceted policy strategy. And recent measures taken in markets and exchanges in response to elevated volatility in commodity prices highlight the need for regulators to examine the broader implications, including exchange governance mechanisms, resiliency of trading systems, concentration of risk, margin setting, and trading transparency in exchange and over-the-counter markets. And there's also this, which I think gets to the heart of the issue, because the debt problem is actually now knocking on the door. The heads of the world's biggest financial institutions have sounded the alarm about record global debt levels, and the International Money Fund's chief says that options for dealing with the billions owed by poor nations are disappearing. We see the problem for many countries getting worse, and the tools to deal with this problem are disappearing, Kristalina Georgieva said in an online discussion with World Bank President David Malpass on Tuesday. The debt problem is knocking on the door and getting louder and louder. Both organisations have for months flagged risks from rising debt levels in emerging markets, particularly as interest rates start to increase to cool accelerating inflation. The World Bank estimates that the poorest countries, whose fragile economies have been decimated by the pandemic, owe $35 billion in payments in 2022. The urgency to avert what has been termed economic collapse for some countries is growing after the group of 20 biggest nations' reprieve on debt service payments for about 70 struggling nations in place since May 2020 expired at the end of 2021. And a plan forged by the G20 in late 2020 to rework the debt of countries in danger of defaulting, known as the Common Framework, has been hampered by a lack of coordination, transparency and clarity. We don't have the debt service suspension initiative anymore. The Common Framework has not yet delivered on its promise, Georgieva said. If we don't want to see countries going into debt distress and from there into not servicing debt, as Sri Lanka just did, let's get serious about the Common Framework. Sri Lanka on Monday asked the IMF for a speedy bailout package as officials battle to save the island nation from economic troubles that have snowballed into a deepening political crisis. And the president of Sri Lanka also said that the nation should have gone to the IMF to request a program earlier. The country is seeking up to $4 billion this year to tide over problems and pay creditors amid dwindling foreign reserves and Asia's fastest inflation. Last week, the country halted payment on foreign debt, leading to a series of downgrades of the nation's credit rating. While the G20 meetings in the past 2 years have been a forum to review the progress of debt relief initiatives and address the need for changes, this week's gathering of financial ministers and central bankers during the IMF and World Bank spring meetings is shaping up to be dominated by a focus on Russia's invasion of Ukraine. The World Bank has had substantial success over the last year, helping countries convert floating rate debt to fixed rate securities amid the prospects of interest rates going up globally. This is going to help just a bit, Malpass said. The $35 billion owed this year by the world's poorest countries, those eligible for assistance under the bank's International Development Association, is both to bilateral lenders and private creditors. There needs to be relief on that front. Some of the official creditors have large amounts of outstanding, and that needs to really be considered as interest rates go up. Malpass said it's just adding to the urgency of this process. So standing back, whether you look at inflation pressures, which they say need to be tamed, the debt problem, which is bubbling away and creating huge amounts of issues, or indeed the broader question of how the Ukraine situation is going to play out and the impact on the broader energy situation, there's so many moving parts and so many concerns. But the bottom line is this: growth levels are down globally, even if Australia is looking a little better. And the context, of course, for Australia is that what happens in the rest of the world is definitely going to hurt us too. So arguing, as the AFR did, that somehow Australia is going to sail through majestically while the rest of the world looks as though it's going to wobble is pretty optimistic. Well, it's probably more to do with the political landscape and the upcoming election than the economic reality. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.